Hi, everybody. My name is Bianca. Thank you so much, Carol, for the introduction, and thank you very much for the invitation. It's really a pleasure to be here in Campinas at Unicamp presenting my recent research. I'm Brazilian. I did my undergrad at the Federal University of Rio and then moved to Leeds, where I met Gary, and we have been working together ever since. Today I will be presenting a recent paper that I am developing in partnership with Marina Zuckermarques at Boston University, as well as Barbara Fritz in the Free University of Berlin, and Anina Kaltenbrunner, who was my former supervisor, together with Gary from the University of Leeds. So the topic that we are trying to research on is below the US dollar dominance. So we are trying to find the patterns of emerging fragmented, multipolar, and multi-layered currency world. So essentially, we are just trying to understand what are the initiatives from the global south to de-dollarize their economies, not so much in terms of internal domestic dollarization, but more about international transactions. So I'm just going to start just the outline of my presentation. I'm going to try to keep to 20 minutes as best as I can. I'm going to start with a brief introduction of our work, then present the theoretical framework that we are using for this paper, then very briefly our analysis, and finally presenting some final remarks. So the current debate that we often see when we are studying currency internationalization or even de-dollarization is whether the US dollar will persist as the key currency of the international monetary system. So whether the euro or any other currency, more recently the Chinese renminbi, is posing any threat to this dominance of the US dollar. But in this context that we have seen in the rise of emerging and developing economies, in the evolving production chains, and those very recent geopolitical sanctions, so you're thinking in terms of Iran and more recently Russia, we can see this very sort of like dissatisfaction with the power from the global north in controlling and having such a great impact over the global south. So especially when we are talking about currency transactions. So despite this dominance of the US dollar for international transactions, we have noticed that the international monetary system has become increasingly complex and fragmented on a regional level. So we have been observing several initiatives from countries in the global south trying to de-dollarize their economies. So Lula, for example, has emphasized this on several occasions, that if I'm trading with my partner in Argentina or whichever country that is, why do I have to use the US dollar? So our research is not so much trying to engage with the literature on currency internationalization in the sense that will the renminbi substitute the US dollar as a key currency of the system. We're not trying to talk about the internationalization of the Brazilian real or any other currency, but we are trying to understand what kind of initiatives led by the global south are put into place to sort of substitute or reduce the dependency on the US dollar for international transactions. So here we have two main research questions that we are trying to answer in this paper. So first, what are these initiatives from the global south that has the potential to reduce the dependency on the US dollar, and how we can conceptualize and assess how effective these policies were that are evolving this below the dollar dominance. So essentially our paper is trying to map all of these initiatives, and as you can imagine, we have several case studies that we are trying to address here in this paper, which is a bit of a challenge because there are many initiatives, but many of them not so successful. So in this paper here, for example, we talk about the internationalization of the Chinese renminbi, because from the global south, this is the most promising one. Regional clearing houses, retail payment system, multi-currency swaps, and finally also local currency lending from development banks. So in terms of theoretical framework this literature on currency internationalization very often uses this very famous table from Benjamin Cohen. I forgot to put the author name here, sorry about that. But essentially you have different types of internationalization in the international monetary system. These are just some of them. In terms of means of payment, you have the vehicle currency, the trade settlement currency, as the unit of account, invoice currency, the currency that denominates trade in an international transaction, as well as the funding currency, which is the currency that denominates your liabilities. And our argument here, this is a quite powerful one. And finally, the investment currency. So in which currency are you denominating your assets in the long term? So we are using some sort of like a post-Keynesian framework to understand this, as we argue that these different functions of money, these different types of currency internationalization are not really quite the same. We have a hierarchy among these different types of currency internationalization, and our argument is that the funding currency lies at the pinnacle of these hierarchies of functions of money. Because at the end of the day, if you have a liabilities denominated in a certain currency, you will also want your assets and other types of transactions that you have also denominated in that currency, because you have to pay that back eventually. Another theoretical framework that we are using in this paper is a concept from Eileen Gravels that she calls the productive incoherence, which is this idea that sometimes a certain policy may seem incoherent, however, it can lead to certain unintended ramifications that leads to positive outcomes that were not intended in the first place. So these are essentially the two theoretical frameworks that we are using in this presentation. So our analysis here, we essentially have divided those case studies that I have mentioned before into two parts. The first one, we separated between credit and non-credit arrangements. Because of this importance of the unit of account, that's why we separated between credit and non-credit, because we argue that this function, this type of currency internationalization, the funding currency, lies in the pinnacle, so that's why we separated them between credit. So on the non-credit side, we have regional payment systems. We also have payment infrastructures like messenger systems that were created to sort of get away from the US dollar. And on the credit arrangements, and our argument is that these are the most essential ones. Emerging markets, for example, economies, investment currencies, or local currency credit. Mostly nowadays we observe this in Chinese renminbi, currency swaps, and finally multilateral development banks lending money to countries in local currency. So the new development bank, for example, has been pushing forward this agenda, and they have this target of 30% that they want to reach this level of local currency lending. So I won't have time to go through all of them, but just to mention that we also broke this down into several parts. So for example, in terms of the regional payment system, you have those systems that only allow trade operations, not really income transfers or any other types of transfers. We have, well, the SML allows for some besides payment, but anyways, we have the SML, the Sistema Monetário de Pagamento em Moeda Local, the SML. We have the CCR, the Reciprocal Payments and Credits. You have the SUCRI. We have the PAPs as well, which is a more recent ones. You also have those, these are with local currency only. We have also the cross-border payments that allow for you to pay in local currency, but still open the possibility to make payments in US dollars. And on the payment infrastructures, you have, for example, the CIPS, which is the cross-border interbank payment system organized by China, and some other messaging systems like the Russian Mir between Russia and Iran, and United Arab Emirates and India. So I don't have time to go through all of that, so I'm just going to focus here in this presentation on the SML, which is what I have studied deeply in my PhD thesis and opens some rooms for discussion. So just to explain the SML very briefly, so this is a local currency payment system put forward by the Brazilian Central Bank in partnership with other central banks from the Mercosur. So in this example here, we have Argentina on the one side, a Brazilian company on the other side, and they want to do a transaction using local currency. So suppose that an Argentinian party needs to pay for the imports of a Brazilian product. So this Argentina company would send payments to a financial institution in Argentina in pesos, so local currency. This institution then pays the Central Bank of Argentina, again, in pesos, and the same would happen on the other side. You would have essentially, after this transaction is done between the central banks, the Central Bank of Brazil would pay in Brazilian reais to the financial institution in Brazil, then pays the Brazilian company. So then, what is the point then? You're essentially saying that the central banks are doing the transaction, the currency exchange in US dollars. So yes, but the difference is that they do the net transaction. So they will get all of the imports and exports from Argentina, net this transaction, same in Brazilian real, get all of the imports and exports related transactions, calculate the net, and then they would only exchange the net in US dollars. If Brazil and Argentina had a more balanced trade, perhaps, this amount here would be very small, right? But that's not the case. So usually Brazil is in a surplus situation with Argentina. So in reality, we have dollars, US dollars being transferred from the Central Bank of Argentina to the Central Bank of Brazil because of this asymmetry between the two economies. But when I was studying the SML, I did several interviews with central bankers in Brazil. I talked to bankers, commercial banks essentially, and also the SML users, trying to understand what are the limitations of the SML. So you have problems that are related to the macroeconomy. So for example, in Argentina, whenever you're making payments locally within Argentina, if that's going to be, you're just going to pay for, I don't know, a supermarket or something with a small value, you pay that in pesos. But for more transactions that are of a greater value, for example, if you're buying a house or even a car, they would make these transactions using US dollars. So in a very dollarized economy, there is a very high incentive. If you're an exporter, why would you want to receive your payments in local currency? You trust the dollar, you prefer to keep the dollar. So this is a macroeconomic issue that sort of, from the start, limits the use of the SML. However, another problem that I have identified when I was doing those interviews is also related to the lack of credit in local currency. So interest rates in Brazil are really expensive, are really high. So it's very difficult for companies in Brazil that want to use the SML to borrow money locally because of the interest rate. So if you take, for example, the case of exporters in Brazil, they usually use ACC or ACE, where they can, essentially the banks will be lending money in dollars, so they will be forwarding the payment, advancing the payment in US dollars, granted that these companies will get paid eventually in US dollars. So for the bank, there is no exchange rate risk for the company as well, so currency mismatch is not really an issue over there, and that's a way. But then if your liabilities, for example, if you go into those contracts, your liabilities essentially in US dollars. So why would you want, again, to use a system in local currency if your lending is in dollars? So it would create a currency mismatch problem. So that wouldn't work. So so one of the main conclusions that we get here is the lack of credit in local currency is a really limiting factor for the SML. So on the credit arrangement side, like I said before, we have identified different initiatives. So for example, you have emerging and developing emerging market economies essentially borrowing internationally in local currency. So then you have the whole discussion of original sin, which is perhaps not so much the case of the global south, not for emerging countries, but the original sin redux, which is essentially you can borrow money internationally in local currency, but whenever there is any sort of like distrust or negative expectations in the international markets, these are the first assets to be sold, which causes exchange rate volatility, which is very problematic. The Chinese credit in renminbi, and we were discussing this yesterday in the lecture of Bruno Di Conti, this idea that China is really pushing with this type of internationalization, potentially even in the Belt and Road initiative. Then we also have swaps. Again, China has been very keen on this type of internationalization. And finally, multilateral development banks lending to the member countries in local currency. So it is one of the challenges that we have in this paper is that we are mapping so many different initiatives from the Global South. So it's quite difficult because it's a bit of a trade-off on how much information we can write for each one of them, because yeah, one might write a book about all of these initiatives. It's quite a lot. So just to summarize here, some final remarks from our paper. So this is essentially, we try to make it a very comprehensive and updated review of the different types of initiatives led by the Global South. That's very important to de-dollarize their international transactions. We have used the approach of the functions of money, but we do emphasize the complexity and the importance of credit instruments in that area. And even though we have demonstrated this, that the international monetary system is quite concentrated around the US dollar, below this very strong dominance of the US dollar, we find this very complex, fragmented, and often regional initiatives to try to change this volatility of these countries in relation to the US dollar. So our argument here is that this is contributing to a partial substitution of the US dollar. So it's not about replacing the US dollar, it's just about reducing their impact in the Global South. And we also observe this gradual, marginal, but potentially significant changes. So once again, coming from this incoherent, productive incoherence towards a more multi-currency system below the US dollar. So another question that we may ask here is that now with the central bank digital currencies and the increasing importance of fintechs and the development in this area, how can this perhaps change the currency hierarchy or the way we understand the currency hierarchy nowadays, which is something that Bruno is also working with. So once again, although these initiatives are not really aiming at substituting the US dollar, they do attempt to mitigate these problems of these countries in the Global South, and perhaps this is a way that these countries can find to protect themselves a little bit more, rather than talking about the internationalization or of the currencies in the Global South, because at least in the short term, this sounds very unlikely, and I don't think it's a policy objective of these countries. So I'm just going to leave my contact here if you have any questions. So I'm very looking forward to the debate. Thank you.
So let me start by saying that Bianca was working with our colleague Nina Kaltenbrunner about this project, about the idea of the non-dollar transactions, and Bianca in particular spent some time in dialogue on the continent with central bankers in Mercosur and here in Brazil, and actually she and Nina won a impact award from the University of Leeds for their great work. It's nice to be at a university that appreciates impactful work, and my colleagues won some kind of big prize last year. I was very proud of them. So I'm going to follow up a little bit by taking a ride on this analysis. And what I'm going to do is show that there's something I've been working with for a while, much of it at the United Nations, in UNCTAD, in some discussions about the development financing and how to finance the SDGs and so on. And only when I saw this work did it become clear where there were roadblocks that were invisible to me, because I hadn't taken on board until I encountered this work and thought more about it, the way in which, you know, what we have here is a collision between basic principles of the operation of monetary systems on the one hand, what is now called the subordinate financialization on the other, and the kind of very particular pathways that people have to negotiate when they're not only subject to subordinate financialization, but when we have agents inside economies working with currencies that they don't fully trust, and therefore, you know, finding their pathways to achieve their material aims, but in ways that make systemic change really difficult. So what we're going to do here is talk about some of the ways. Now, if I touch this thing, oh, no, it won't. Okay. How about that? That's good enough. Okay. The thing that I've been working with, with some of the colleagues at the United Nations, has been to try to push along some of the financial aspects of the development agenda, and in particular, something that's been a major initiative has been how to finance this so-called sustainable development goals. Now, you know, the SDGs are controversial for many reasons, but they include climate sustainability among other packages. And the conversation in the UN is about the SDGs, not about climate finance per se. At least it has mostly been, at least in UNCTAD it is, because basically you can't talk about saving the planet if you're not talking about working with the people, at least in the United Nations Conference on Trade and Development. Now you'll see where that doesn't quite work when we get to the UN as a whole. Now the markers here, 2015, they had passed the SDGs at the turn of the century, of course, but it's the so-called Addis Ababa Action Agenda was where there was an agreement to finance the SDGs. And at that same year, ironically, was where you had the Paris Accords. The IPCC did its negotiation to say that the nations of the world should also sign up to do climate financing as well. The estimate that has been kind of used, and it's floated up and down, but it's a big number. It's $2.5 trillion per year to take care of the SDGs. You get a number about half that size if you look at climate per se. And it looks like a lot of money. It is a lot of money. It's about 3% of the global GDP. If you go back and look at John Maynard Keynes' plan in the late 1920s to revive the UK economy, suffering then from the Great Depression, he was working with a plan that he considered possibly too small to do the job. And that plan came to about 3% of the UK GDP at the time. So the number is not an unreasonable number. Now, what was taken on board as the main vehicle for getting this done? Something called blended finance. Now, blended finance, the idea here is that you use private sector money to do the financing needed. This would be country by country, around the world, all the various things to take care of both climate mitigation and or climate adaptation. Now, we won't get into details about all of that. But basically, that private capital would then be underwritten and supported by risk-bearing public or quasi-public capital supporting it. In fact, and so basically, banks would make the loans. Private banks could be, or multilateral development banks, but these loans would be supported and underwritten by the guarantors, who would be basically public banks and maybe international and multilateral development banks, and then they'd be securitized and sold off. Now, Let me give you a picture first. Here's a kind of picture that comes from this. Convergence was one of the countries that was selling their services big time in the Glasgow meetings about the climate. And it's just a picture that shows you the deal. Private capital on top, and then they get their market rate, and they blend together and make a financing structures, which are done through development funding support provided by, as it said, public and philanthropic funders. Then basically the idea would be that this would be offered on concessional terms, and then the availability of developmental funding here, you see that dotted line going up. The idea there is that the availability of the subsidies and would make the money flow, so that would mobilize the private capital, and then the fact that it would be offered on concessionary terms should get the public sectors into the picture. So that's the idea there. Now, just to go back for a minute, you got to scale this system up, obviously, and there was a whole system they worked out. There's a 2017 report done by a small group of experts for the G20. And basically, these are the kind of people that would get together after the global financial crisis and have a small meeting and agree on what should we change. The kind of insider economists at Ivy League and elite universities in the global north. And they came up with this plan that you'd have the IMF board and control the whole thing. You'd have the World Bank and the other international financial institutions and multilateral development banks, which in this system would turn from making loans to underwriting loans. They would change their roles. They'd shift from loan making to loan guarantees. And then at the bottom, you've had national governments doing all this. Of course, this would take huge changes. You'd shift the role of the World Bank. You'd basically need the nations to step up and be able to think of, plan, and implement these projects. You'd need mega funds that would be able to move this money and hold it. And you'd need to hedge against all kinds of risks, including political and foreign exchange risks. And you'd want to get pension funds and other funds involved. Notice, for those of you who paid attention to the changes in global banking, that there's a lot of possibilities for making fee-based income on the page here. And that was, of course, always especially attractive in that system. Now, high expectations have not been made. Basically, they're not really mobilizing much money, first of all. And the idea that this is the Overseas Development Institute of the UK had an analysis where they say, in that second paragraph, expectations that blended finance can bridge the SDG financing gap are unrealistic. Billions to billions is more plausible than billions to trillions. So basically, they've not achieved their goals. And so where do we go from here? Now, where we go from here, despite the fact that there was this disappointment, is we continue to push the product. And just to show you here, you go to Glasgow. Here's the big cover page for the Glasgow meetings of the IPCC, the COP26. Again, I'll spare you the details, but it's just all about blended finance as the favorite platform. Then they talk about, well, here we need 1.2 to 2 trillion per year, and basically lots of the development finance is targeting climate action, but it's underutilized. And they note that there's many transactions, so they're bragging about the number of transactions, but the gap is huge. Sparing you the details, just more details here that they're not meeting those goals. And then they show people, here's what you need to know, here's what you need to do, here are the people to call. It's Safia Gulabani, apparently, who knows all about it. But we go, actually, so that's 2022, we go to 2023, and we're going now in November of 23 to Dubai. Now, there we are, and once again, it's all about, there's your big countdown, it's all about climate finance, and specifically blended finance, still selling it. And you remember the controversy there about Dubai. And basically, once again, this recognition that actually we're nowhere near enough money to go forward with that. The financing needs is far greater than the pledged 100 billion per year. If you remember, the figure was 2.5 trillion. But even though that was the pledge, actually, just to say that it's been nowhere near met, there was an analysis done by these people at Boston University, and their analysis shows that actually, here's from a report from last year, the circled in red, what we see there is that blended climate finance, according to the State of Finance report, has been on a declining trend, sinking to 14 billion in 2020 from 36.5 billion. So they're far short of any goal that they might have. But now here's the thing. How do they think they're going to do that? They want to standardize it, right? They want to standardize a tool. And basically, what they're going to count on to deliver that tool is a system of mega banks. And this is a system, of course, that brought you the subprime crisis. But these are basically now the institutions expected to deliver climate finance. And that, there's your private sector. And so essentially they want, how are you going to get these folks to deliver at speed and at scale in ways that will basically, work. And essentially, let's just make a quick note here that we've had something like blended finance before. It's a deja vu all over again. The Latin American debt crisis ended with, of course, many U.S. banks, who were subsidizing and lending for the commodity boom, the idea that there were resources without limit that could be tapped in Latin America, followed by a terrible collapse and all of that we talked about last week. And basically, the U.S. money center banks were on a path to fail. We'll talk about that actually, I think it's next Monday, that other lecture I'll do. And basically, they created Brady bonds to take the loans off the bank's balance sheets. Now, they made a lot of these loans, and these loans became so many that it became an asset class. I think this is the vision that people have for the blended finance. They imagine that this can be not just an asset class that would work with a particular emergency, but it becomes commodified in the market. Brady bonds grew from 160 billion originally up to 1.7 trillion at the peak. And or actually it looks like, 6.5 trillion by 2008. Brazil, of course, had some that they finally paid off during Lula's time. And essentially, lots of trading there, lots of money. But here's the thing. Brady bonds have been proposed as a new solution for debt restructuring. Now, it's going to put us right back to Bianca's point in the contradictions. Why are we talking, once again, it's that BU group, why are we talking about Brady bonds now? Well, actually, for debt restructuring in the post-pandemic era. Why? Well, we have a new market landscape. What's the market landscape? That we have one of the worst situations of developing country sovereign debt that we've ever seen, if not the worst. And actually, let me show you, here's the graphic. Emerging market debt, Eurobond issues have been growing tremendously. That the argument here is that it's a growing market. And Latin America's in there along with others, Asia Pacific and so on. But here's a graph that talks about the fact that there is a huge number of sovereigns that are in trouble right now. This is post-COVID. This is the capital flight and the other issues that have arisen. And look at the percentage of sovereigns that are being downgraded, by different rating agencies. The different colors there show you, Fitch, Moody's, S&P, and so on. We have about a third or more of Latin American countries being downgraded. Actually, a surprisingly high number of developing Asia being downgraded. Same thing in the Middle East, and of course, Sub-Saharan Africa, of course, is on the bottom of that league table. And what they're talking about here is something that looks an awful lot like that blended finance instrument. And the thing about this is that it's the same thing. You transform the debt, you make it market, and then you get it sold. Again, what you need is scale. However, if you think about everything that has just been said, we want to trade. We want to take care of climate finance. We want to do things. What's on offer? What's on offer in this whole system is dollar-based loans. The whole system is external credit in external currency that pays no attention to the actual currency hierarchy and the problems of the dollar dominance that features centrally there. And so you're asking the countries that are most subject to climate change to go into dollar debt when they're already, as you have seen, head over heels in debt because of the slowdown in the global South economy. One thing that, a point I made last Wednesday was there's that one graph that shows you how after the Great Recession in 2008, 9, et cetera, we see a reversal on the global structure of trade. We see that whereas before that, the global north was in deficit to the global south, so to speak, on trade. So a global south country could think of trading its way to growth. What we now have is a flip, where now it's the global south nations that as a whole, as structurally speaking, are in deficit, and it's the global north, which of course, those countries, the Eurozone and so on, really slowed their economies down. We've had macro austerity in the UK for 13 years now. And the consequence, of course, is that that has a global impact. That means that we now have debt-led growth of whatever type in the global south, and that then gets reflected and then, of course, multiplied in the crisis. Now, back to the United Nations and the end of the story. You'd think, wouldn't the United Nations see this? And I have to tell you, when the United Nations conversations are dominated by insiders who mostly come from the global north, or else they've had their minds kind of colonized by working in Washington, D.C. or other places, and they kind of forget about that whole context. So we have this report of the Secretary General, Our Common Agenda, launched in 2021. Now, that common agenda, that was basically the Secretary General Guterres, who's probably, seems like a nice guy, but basically, saying, we got to do something, we got to climate finance, we got to do all these things. Now, I'm not going to go through that report because I'm about to finish my brief remarks, but just published yesterday was a report by the Brookings Institution, co-authored by a whole bunch of people. These lead authors, you recognize a couple of these names, Eswar Prasad and Mary Lou Uy. These are, these people, and Ghanem is pretty good. There's also Jose Antonio Ocampo was part of this discussion, and some other folks too. These people are not saints. They're mostly very influential, again, insider, mainstream type economists that are a little bit more open-minded than that G20 group. But, and so essentially the G20 says, right, blended finance, let's use the private sector. But these folks now are going to have a critique. Now check out their critique. And here I will ask you to look at this text a little bit. Basically, I'm just going to quote a couple of sections here and then wrap it up. It's disheartening. So their reflections on that's the UN policy brief is that Our Common Future report. Big, long report, by the way. It's not brief. On sovereign debt. They say it's disheartening to see 40 years after the debt crisis in the 1980s and after the initiative, the world's once more facing a sovereign debt problem. Hence, the US policy brief recommendation makes a lot of sense. Will it be enough? Probably not. Now, they note that they talk about 4 actions. Consolidate and increase climate financing. This is the UN recommendation. Aligning with Paris targets and better coordinate among remaining climate funds. The Green Climate Fund, which is a small joke, by the way, minuscule, needs to be replenished and function better. Secondly, the MDBs and donors need to assess and report on whether climate finance is additional to development assistance. Thirdly, increase adaptation financing. And then fourthly, operationalize the loss and damage fund. Oh, there's another bad joke, but let's leave that one aside. The thing is that, they note that basically this policy brief is not going to work. Essentially we need collaboration, we need co-financing, and the poorest for the poorest to benefit, we need to really take development assistance more seriously. Now, this is just the last page of reflections from these people. And so I made it small so it fit on one, because I know you'd be tired of me by now. But basically, here's their summary on what's wrong with the policy brief in terms of development and climate financing. Okay, all we got to do is focus on the bold-faced sentences. Calls for turning the World Bank into a climate bank do not sufficiently consider the priorities of the global South. Okay, and go down more. Adaptation, loss and damage, and just transition could be considered as national public goods. And we need a lot more of that. Mitigation itself is a pure public good. So, it's helpful. The thing is that even this discussion, though, is completely blind to the very problems that are being highlighted in Bianca's research, and that we'll bring into our discussion as we turn that into, I think, a different paper. And just my final slide here in conclusion, the very fact that you have to talk about blended finance already tells you something about the incentives and the operations of the globalized financial system. They're only going to save the world and humanity if they can do it without taking a risk, and if they can do it at scale and at speed and make a lot of profit from doing it. In other words, if they can increase the world's inequality problem. I don't know if you've come across Kim Stanley Robinson, in rather remarkable science fiction author. He's got a book called The Ministry of the Future, in which he basically starts the book by talking about an incident in India where 25 million people basically are incinerated in, I think it's the years 2030 in his book, basically because of literally a killer heat wave. And he basically starts from there and says, like, is anything going to happen? Does anybody care? And you can do your own thought experiment. How many people in Bangladesh might die from flooding in the wake of one of the monsoons there before anybody's going to care? And basically, he doubts it. And of course, these desperate conditions are actually already here. So any adequate financial response to these problems of humanity's development and sustainability is going to require no less than a giant push. This seems at present, right, like an unachievable science fiction scenario. Another unachievable science fiction scenario that we're treated to seeing is Elon Musk's idea of terraforming Mars. It's like, thank you, Elon Musk, right? But basically, we need more than this. We need your generation. We need economists around the world to continue to push, because that Brookings report, while it does not see the problems that Bianca and her colleagues are focusing us upon, at least is moving in a more humane and realistic direction. And I think that that's part of the function of those of us who are economists on the left. Keep pushing these people. Maybe you're not going to get that senior fellowship at the Brookings Institution, but push the people who are there. Push those Eswar Prasads and those other folks, and basically let's get them closer and closer to where we need them to be. Because we got to use our collective human imagination. Things like these ideas that Bianca was showing, where you can kind of, let's say, engineer around some of the severe limitations of a current system without insisting that we completely change that system and everybody turn into cooperatives that are using currencies that don't exist yet. The part of the beauty of what she's proposed, leaving aside the fact that people are maniacs for dollars, is on the transactions that surround that, is that that's something that you can implement without basically saying we need a new IMF, we need a new World Bank, we need a new United Nations, scrap everything, and we need a new global financial system. Forget it. What we need is an accountable global financial system and an accountable United Nations, IMF, and World Bank. And by the way, that Brookings report is well worth taking a look, because they've got some very interesting, maybe good enough ideas for how the IMF itself, in its structure of control and governance, could be changed in ways that would make them a more effective institution. So, we need this imagination of what the future has to be to inform what we can do now, because it's not too early if it's not already too late. All right, I'm done. Thank you.